Okay, so you want to build a rental property empire, buy a few houses, collect rent every month, let your tenants pay off your mortgages, retire early while your portfolio quietly grows in the background. That's the dream. And surprisingly, it isn't fiction. Some people really have built multi-million-dollar real estate portfolios using exactly that strategy. But here's the part almost nobody talks about. Most first-time investors who chase that dream don't end up financially free. They end up working harder than they did at their regular jobs while carrying hundreds of thousands, sometimes millions, of dollars in debt that constantly demands attention. The difference isn't luck, it isn't timing alone, and it certainly isn't buying the most properties. The investors who build lasting rental empires understand one thing before they ever sign their first purchase agreement. They understand the math. Because a rental property isn't simply about buying houses, it's about buying cash flow. It's about controlling risk. It's about understanding leverage before leverage begins controlling you. By the end of this documentary, you'll know exactly how rental property empires are actually built from the ground up. We'll break down the real startup costs, follow the revenue model from the first rent payment all the way to long-term wealth, uncover the hidden expenses that quietly destroy returns, study investors who built real portfolios using real numbers, examine the mistakes that repeatedly wipe landlords out, and finally, we'll calculate exactly what the profits really look like in two realistic investment scenarios, because the truth is surprisingly different from the social media version. Owning rental property can absolutely create wealth, but passive income has a very active beginning. So where does every rental empire actually start? Not with 10 properties, not with apartment complexes, not with financial freedom. It starts with one door. Imagine you're buying a single-family home in a stable, mid-sized American market. Somewhere like Columbus, Ohio, or Kansas City. A neighborhood with steady employment, reliable tenants, and long-term housing demand. The purchase price sits around $200,000. At first glance, that number doesn't seem impossible, until you remember you're buying it as an investment property. Banks treat investment properties very differently from primary residences. That means the down payment immediately changes. Instead of putting down 5% like many homeowners, you'll usually need 20 to 25%. That's $40,000 to $50,000 in cash, before the bank even hands you the keys. Then come the closing costs, loan origination fees, title insurance, legal paperwork, transfer taxes, inspections, appraisals. Depending on your market, another $5,000 to $10,000 disappears before you've earned a single dollar in rent. And us experienced investors know something else. The day you close is usually the day something breaks. Maybe the water heater fails. Maybe the furnace stops working. Maybe a leaking pipe suddenly becomes your responsibility. That's why professional investors never spend every available dollar on the purchase itself. They build cash reserves before they buy. A reserve fund isn't optional. It's part of the investment. Most operators keep at least $5,000 available for unexpected repairs immediately after closing. Now, add everything together. The down payment. Closing costs dot emergency reserves. Your real entry cost for one rental property isn't $200,000. It's roughly $50,000 to $65,000 in cash before collecting your very first rent payment, and that's only one property. Because almost nobody dreams about owning one rental house. They dream about owning a portfolio, 5 houses, 10 houses, maybe 20. Enough rental income to replace a full-time salary. That's where the capital requirements become much larger. Suppose your goal is 5 properties, each valued around $200,000. Assuming conventional financing, you're deploying roughly $250,000 in cash before building what most investors would consider a small rental portfolio. For many people, that's the first major obstacle. Not finding properties, finding capital. Naturally, investors began searching for faster ways to grow. That's where one of real estate's most famous strategies enters the picture. The Bayes RRR method. Buy, .rehab, .rent, refinance, repeat. The concept sounds almost magical. Buy an undervalued property, renovate it, increase its market value, rent it to a tenant, then refinance the property based on its higher appraisal, recover much of your original cash, and recycle that money into another purchase. On paper, it looks like a machine that creates rental properties almost indefinitely. Sometimes it works exactly that way, but only when every step goes according to plan. Finding distressed properties isn't easy. Managing renovations requires experience. Contractors miss deadlines. Budgets change. Unexpected structural problems appear behind walls. Appraisals don't always reach expectations, and lenders don't automatically approve repeated cash-out refinances simply because the numbers looked good on paper. The BRRR method isn't passive investing. It's active project management disguised as investing. Successful operators understand they're not simply buying houses. They're managing construction projects, financing relationships, contractor schedules, inspections, and tenant placement simultaneously. Some investors choose a different path entirely. Instead of building portfolios one house at a time, they move toward multifamily real estate, apartment buildings, small complexes, properties containing 5 or more units. The financing changes immediately. Banks begin treating the investment as commercial real estate rather than residential lending. Commercial financing brings new opportunities. It also introduces new challenges. Interest rates often increase, loan terms become shorter, lenders expect stronger financial documentation, business entities become increasingly important, personal guarantees become common, everything becomes more professional. Because at that point, you're no longer buying a house, you're operating a business, and that's the biggest misconception surrounding rental property investing. People think they're purchasing real estate. In reality, they're acquiring an operating business that happens to be built around housing. Whether you own 1 property or 100, every rental portfolio follows the same financial model. Money comes in, money goes out. Whatever remains becomes your cash flow. It sounds incredibly simple. Collect rent, pay the mortgage, cover expenses, keep the difference. Unfortunately, the difference is usually much smaller than most people imagine. Let's take that same $200,000 home. Suppose it rents for $1,600 every month. For a clean 3-bedroom house in a stable market, that's a realistic number. Over 12 months, your gross rent reaches $19,200. At first glance, it feels promising. Nearly $20,000 arriving every year from a single property. But gross rent isn't profit. It's only the beginning of the financial journey. The largest deduction arrives almost immediately. The mortgage. Assume you financed $155,000 using a typical investment property loan. With interest rates around 7.5%, your monthly mortgage payment lands near $1,085. Over a year, debt service alone consumes more than $13,000. Suddenly, that impressive rental income looks much smaller. Your gross margin has already narrowed dramatically, and the biggest expenses haven't even arrived yet. And this is where most first-time investors make their biggest mistake. They stop running the numbers because once the mortgage has been deducted, it feels like the difficult part is over. It isn't. In fact, the real business has only just begun. Every rental property carries a second layer of expenses that quietly consumes cash flow month after month. Property taxes arrive whether the house is occupied or not. Insurance protects the property, but it also protects your investment from becoming a financial disaster after one unexpected event. Maintenance never completely disappears. Roofs age, water heaters fail, plumbing leaks, appliances wear out. Even a perfectly maintained property slowly depreciates through everyday use. Then comes vacancy. No tenant stays forever. Every lease eventually ends. Even if your property rents quickly, there will usually be days or weeks when the home produces absolutely no income while the mortgage keeps arriving exactly on schedule. Let's go back to our $200,000 property. Annual property taxes might average around $2,400 depending on the state. Insurance for a rental property commonly falls between $1,200 and $1,800 every year. Professional investors also reserve roughly 1% of the property's value annually for maintenance and repairs. On this house, that's another $2,000. Now, account for vacancy. Even losing only a few weeks of rent every year can easily remove another $900 or more from your annual income. Suddenly, those expenses begin stacking on top of each other. Property taxes, insurance, maintenance, vacancy. Combined, they consume thousands of dollars every year before you've paid yourself a single dollar. When you subtract those costs from your remaining gross margin, something surprising happens. Your cash flow turns negative. Instead of earning money every month, you're contributing money to keep the investment alive. For many new investors, this feels like failure. It isn't. It's simply incomplete math, because cash flow is only one part of real estate investing. The rest of the return is happening somewhere else. Every mortgage payment gradually reduces the loan balance. This process is called principal paydown. In the first year, only a small portion of every payment goes toward principal because interest consumes most of the payment, but every year that percentage slowly shifts. Less interest, more equity. Eventually, your tenants begin paying off larger portions of your mortgage without realizing it. Then there's appreciation. Historically, many stable housing markets have appreciated around 4% annually over long periods. On a $200,000 property, that's roughly $8,000 in additional value every year. You don't receive that money immediately. It exists on paper. But over 10 or 15 years, appreciation can become one of the largest sources of wealth creation inside a rental portfolio. There's another advantage many new investors overlook: depreciation. Although the property may increase in market value, tax rules allow investors to depreciate the building itself over 27.5 years. That creates paper losses that can reduce taxable income, subject to IRS rules and income limitations. Professional investors don't evaluate rental property using only monthly cash flow. They evaluate total return, cash flow, principal paydown, appreciation, tax benefits, combined together. That's where rental property begins separating itself from many other investment classes. But here's the important distinction. Appreciation doesn't pay your mortgage next month. Depreciation doesn't replace a broken furnace. Paper wealth doesn't solve cash shortages. Cash still matters. That's why experienced operators rarely buy properties based on hope. They buy properties based on numbers. Instead of asking whether they like the house, they ask whether the house produces the cash flow they require. The property either meets their investment criteria or they walk away. One benchmark appears over and over throughout the industry: the 1% rule. The idea is simple. Monthly rent should equal at least 1% of the purchase price. If a property costs $200,000, investors ideally want around $2,000 in monthly rent. Unfortunately, today's housing markets rarely make that easy. Many cities simply don't produce those rent levels at current purchase prices. That's why experienced investors constantly search for opportunities other buyers overlook: off-market properties, distressed homes, motivated sellers, emerging neighborhoods, markets where purchase prices remain relatively low compared to rental demand, because improving the purchase price often improves every financial calculation that follows. And then come the expenses almost nobody mentions before you buy. Not the obvious expenses, the hidden ones, the expenses that arrive after you're already financially committed. Tenant turnover is one of the biggest. Every time a tenant moves out, the property immediately stops producing income. Now the cleaning begins. Fresh paint, carpet replacement, minor repairs, advertising, tenant screening, background checks, professional photography, property showings. Weeks can pass before another lease is signed. The total turnover cost on a single rental property can easily reach $2,000 to $5,000. And that's assuming everything goes smoothly. Sometimes it doesn't. Sometimes the tenant simply stops paying rent. Now you've entered one of the most expensive situations in residential real estate: eviction. The timeline depends entirely on location. Some states process evictions relatively quickly, others move painfully slowly. Meanwhile, the mortgage continues, taxes continue, insurance continues, utilities continue. Every month without rental income increases the financial pressure. On a small portfolio, one difficult eviction can erase an entire year's profit. Then come capital expenditures, often called CapEx. These aren't everyday maintenance items. They're the major replacements every building eventually needs: a new roof, a complete HVAC system, foundation repairs, exterior siding, kitchen renovations, bathroom remodels, large plumbing replacements. Many new landlords budget for maintenance. Very few budget properly for CapEx. But the difference is enormous. Maintenance keeps equipment running. CapEx replaces equipment entirely. One protects the asset, the other rebuilds it. Professional investors prepare for both long before either expense arrives. Insurance contains hidden gaps too. Standard landlord insurance doesn't automatically protect against every possible disaster. Flood damage often requires separate coverage. Certain types of mold remediation may exceed policy limits. One unexpected event without the correct insurance rider can generate repair bills worth tens of thousands of dollars. Property management creates another decision. Many investors eventually hire professional managers. They collect rent, coordinate repairs, screen tenants, handle maintenance requests, manage lease renewals. The convenience is significant, so is the cost. Management fees commonly range between 8 and 12% of monthly rent. Across one property, the expense seems manageable. Across 10 properties, it quietly becomes tens of thousands of dollars every year. Then there's one variable investors can't control: interest rates. Between 2010 and 2021, many investors financed rental properties using historically low borrowing costs. Money was relatively inexpensive. Cash flow calculations looked far healthier. Then interest rates increased dramatically. New purchases became more expensive. Refinancing became far less attractive. Some investors who relied on floating rate debt watched profitable properties become negative almost overnight. Not because rents fell, because financing costs rose faster than rental income could keep pace. That's one reason the strongest operators always maintain healthy cash reserves. Cash reserves create time. Time creates options. And options often determine whether a portfolio survives difficult markets. So who actually figured this business out? Who turned rental property into a real enterprise rather than a side investment? Let's look at a few operators whose businesses demonstrate exactly how scale changes the economics of real estate. Some investors prove that rental property can become an extraordinary business when the numbers work. Grant Cardone began with residential real estate before shifting his focus to multifamily apartment complexes. Through Cardone Capital, he built a portfolio controlling thousands of apartment units worth billions of dollars. His strategy wasn't simply buying more properties, it was buying scale. Large apartment communities spread maintenance, management, and operating costs across hundreds of units, making each individual property more efficient. Brandon Turner followed a different path. He started small with house hacking, living in one unit while renting the others. One duplex became a 4-unit property. The 4-unit became a larger apartment building. By purchasing in overlooked markets where the 1% rule still made sense, he replaced his employment income with rental cash flow long before owning hundreds of units. The lesson is surprisingly consistent. Neither investor bought properties because they looked attractive. They bought deals because the numbers justified the purchase. Unfortunately, not everyone follows that rule. The most common reason rental portfolios fail isn't a housing crash. It's becoming over-leveraged. An investor buys several properties with minimal cash reserves, accepts negative cash flow, hoping appreciation will solve everything, and then one unexpected event changes the entire portfolio. A major repair, a long vacancy, an eviction, higher interest rates. Suddenly personal income begins covering mortgage payments, credit cards replace cash reserves, one foreclosure damages the entire portfolio, and years of progress disappear faster than they were built. The investors, who survive difficult markets, usually share one habit. They never depend on appreciation to rescue a bad investment. Appreciation is a bonus. Cash flow is the business. That's why rental property should never be evaluated by monthly income alone. Every month, your tenants help reduce your mortgage. Every year, appreciation can increase your equity. Tax benefits improve long-term returns. Inflation gradually raises rents while fixed mortgages become easier to carry. Over time, multiple small advantages begin working together. That's how ordinary rental houses slowly become extraordinary wealth. The truth is simple. A rental property empire isn't built by collecting rent. It's built by buying the right properties, protecting cash flow, controlling leverage, maintaining reserves, and making disciplined decisions year after year. Because real estate doesn't reward excitement. It rewards patience. The people who eventually retire on rental income aren't the ones searching for shortcuts. They're the ones who treated every property like a business long before it became an empire. And that's the secret business of rental property.